Good morning, good afternoon, everyone. My name is Russ, and I would love to welcome you all to our Friday update here on Datadash. Guys, despite the fact that today I'm out of office, I'm out of my studio, I'm sitting somewhere in the middle of the Greek islands, I still wanted to sit down and give this update to you because in our comment group, I see a lot of bullishness, I see a lot of app-only narrative, and I understand that a lot of people are totally disarmed based on inflation, expectation, and Fed target rates, anticipated cuts. And they are thinking that from now onwards, everything is just going to inflate down and there is no point to worry. It's the holder mentality. And I am personally very much affected while seeing the people sitting over, losing the money and bleeding positions and not being ready at all, not hedging themselves against the potential crash. So here I am about to go into the charts together with you and give my outlook on S&P 500 and how I gotta play the game. Where are my triggers? Where are my targets? How would I anticipate the correction or even the crash, which is more than 20% correction? With all that said, guys, let's go. There are several compelling reasons to anticipate a significant stock market correction or even a crash, which I believe is inevitable, and the monthly chart, in my opinion, vividly illustrates that. So similar to the analysis where we looked at the gold prices in the last months, I can see multiple divergences here, and the divergence that is forming on the monthly is starting to be quite prominent on both RSI and MACD histogram, as well as the money flow index, and so on and so forth. So the recipe here for correction, I think, is already being well organized, and its correction is cooking up. So the RSI demonstrates those divergences. It doesn't mean necessarily that we're going to go down from here. And for those reasons, I would recommend to go actually on the weekly. On the weekly time frame, our current RSI have been in the most extended territory, similar to 2018, that actually we never been that high since 2018. And what happened in 2018? We had those 15-20% correction in a matter of 2 weeks. So once again, I'm not saying it happens right now, but also looking at stochastic MACD and the fact how we start creating those bearish divergences on every peak we are forming, I am looking forward to conclude that the correction on the weekly might appear also sooner than later. And the daily also reinforces what weekly and monthly have to offer, with the bunch of divergences forming on the daily time frames. I would personally expect the small blow of top or the breakout of the previous all-time high with a bunch of retail loading here, expecting that this is an up-only environment where the Federal Reserve gonna step in and gonna cover any deficits that would appear in the system, when then the market would actually reverse. And what would be the trigger for those reversals? The trigger number one would be the bearish divergence on the daily time frame on S&P or Nasdaq. Everything I'm saying today regarding S&P, you can apply and follow the same logic on Nasdaq. There is no difference. Looking at the RSI here, you see that it's very probable that even if we push another 100 points here and still create those lower RSI, let's say 50 or 60 on the daily, that is a perfect recipe for the beginning of this correction. The point number two, in my opinion, would be the 10 to 2-year yield curve, which is going to turn positive. Let's have a look on that chart in a second. You can see S&P 500 on the yellow charts and the 10-year minus 2-year yields on the normal chart with the red and green bars. And so what happens every time that yields get uninverted with this kind of a hockey stick environment, and I expect that to happen here at any point, at some point, rather sooner than later, we have a very sharp correction here on S&P 500. It can be a sharp decline of more than 20%. I'm not saying we're going to have like a huge crash, but 20% is quite realistic in my opinion. And moreover, this 20%, if you're just going to purely come back to S&P chart and look at it, so 20% is pretty much nothing crazy. It's just going to signify the retest from the all-time high in the upper band of the previous range. So I would not say that this is like very doom calling correction. It's just a simple retest of the previous range before we broke out into the upper one. So I would have to point out we need to be prepared for that scenario. Just wanted to point out additionally that the yield curve on inversion works more than it doesn't. So in 2000, the crash around 50% could have been noticed with the yield curves. Here we are again in the dot-com crash, 2007, 2008, around 50% plus. That is also something that has been on the charts. So in my opinion, the yield curve, US 10-year minus 2-year yield curve, this is the chart you need to start watching quite often. That should be a weekly routine in my opinion, because when this uninversion happens, it is very likely that it would actually cause the meltdown in the stock market. But now I have the third indicator no one actually speaks about. And here I'm talking about the ticker HYG, or the high yield bonds that have the tendency to call the bottom every time in the S&P 500. And this is the indicator not so many people are actually aware about, so it's not going to be overcrowded. I really recommend you using it. Let's just chart HYG for a second. So far, HYG is holding quite well, but in my opinion, the breakdown below this level of 76 might signify the start of the sell-off, and that can be quite a negative outcome for the stock market per se. Why I'm saying that? Well, because looking at the historical data, those two are always correlating with each other. There are actually multiple articles that highlight the very high degree of the correlation of the high yield bonds cycle low and the S&P 500 cycle low. And without going too much into the backtesting of the data, I can tell you guys that those high yield bonds are predicting the stock market way better than the 20-year treasury bonds, TLT, or any other bond ETFs. For those reasons, I've done the research and recommend you following that. When it comes to the levels of S&P 500 or SPX index itself, does it mean that I'm gonna start shorting the market somewhere here or somewhere here? No, that's not enough of confirmation for me to enter those trade and to start hedging. So where is the level I'm looking at? The level I'm gonna be looking at is here at 49.50, because 49.50 will be a clear level where we are actually losing this low, and we're gonna start printing the lower low after potentially we print the higher high. But if we don't print the high, my logic is still the same. I want to see the market structure break, and from those market structure break, I would not enter the entire position. I would still wait for a bounce, and on that bounce, somewhere between here and here, wherever our previous high is, I would start loading the put options and selling the call options on my already existing value plays, such as Imminent Lithium, such as Baba, such as several other stocks. As far as you remember, the last year's unemployment rate came above hotter than expected, and non-farm employment change was lower, so that kind of gave the room for all the reporters, all the journalists to call for the Federal Reserve to step in and to actually start doing the cuts, which they were in a way not expected to do based on the previous months of data and based on inflation still being very hotter than expected. But on top of that, the wage growth tracker shows us the huge decline in the last few months. And on top of that, the median sale price of the house in the US are also giving us that drop. All of those are pretty much the entry scenarios for the recessions to start. And normally how the Fed reacts on those, the Fed goes and cuts the interest rate. But what happens when actually Fed cuts the interest rate? Let's see 2011, the beginning of the cuts, minus 25 basis points. And what gonna happen in the chart afterwards? 2001, bum, and 50% drop. The Fed actually really cut the top, on the top of the S&P 500 back then, which was around 1,600. What happens afterward? Fed starts cutting again in April 2008, as the form of the housing market crash emergency. And what happens back then on the charts? Well, that is exactly the top of 2008. So we have that spike here and then another 50% drop. So I'm not so excited of the Fed to cut. The Fed to cut is actually kind of buy the rumor, sell the news events, and this is why I will be very vigilant looking on the upcoming cuts, talks, and discussions. With all that said, guys, once again, people might ask me, oh, why don't you just sell and then, buy lower when the recession hits in? So you like buying in with like 30-50% discount. Well, unfortunately, it's pretty much impossible to predict when exactly the recession will hit in. That is why I'm giving you the tools how you can monitor that for yourself. But no one, absolutely no one, including Jamie Dimon or whatever, other people that are actually expecting the recession sooner or later, they all start to speak about it. We see a bunch of insiders selling in the stocks, including Jeff Bezos, Elon Musk, and so on. Some of the people said, well, they actually just have the better place to allocate their capital. And I agree with that. My point is here alike. I don't think that just sitting on the sidelines is the winning strategy. I think you need to play that game, but being aware of what can happen without all this up only and melt up expectations, because that's gonna be a huge disservice for yourself. And losing the capital is something I strongly advise against, because you can understand if you burn 50% of your capital, then it turns 100% return to actually come back to where you were, and it's already so much harder. And this big correction in the stock market would actually be the signal for the Fed to come back to the quantitative easing and start amending their entire policy. So that, in my opinion, would only add more gasoline on the fire for gold and silver. And I've seen multiple comments in the comment section down below. Russ, what about silver? What about the silver plays? People asking me in the chat, oh my God, some of my play is 10% down. First of all, those are my plays, and I am not anyhow shaken out of my conviction. And on top of that, I think this is just an absolutely beginning. We are just starting, guys. Looking at gold, for example, on a 4-hourly time frame, I think that the correction is over, and the next target would be around 2,500. However, I am still not fully out of the probability of gold to retest 2250. 2250 was our level here of the breakout, and it might happen that the metals that are actually trading more often than not across these meme lines, but I would never draw this line on the crypto market, simply because they're way less liquid and they're used to lure the retail investor into a particular position. But here on the large asset classes like $11 trillion in gold, those are actually working more sustainable. So 2250 is my last low for gold, and then I would expect a bounce. When it comes to silver, we definitely have broken out of this trend line on the good volume. I am a little bit worried that we have not backtested 26.5 area, neither 27, so we might actually come back to that zone, but that's not given. That's actually can be very possible that we're never going to revisit those levels, simply due to the gold to silver ratio being a separate input for all of our charts. And here, gold to silver, for those who missed my main video on silver, I'm actually going to put it here so you can click and watch. This is a very textbook pattern of the lower highs and lower lows that we are printing here on gold to silver, where, as I mentioned, the amount that we produce right now is not 82 to 1, it's roughly 20 to 1, and the amount of the silver that we have in the earth crust is just 8 to 1. So this disparity I'm seeing way lower, towards the 40s range, and that gives me the conservative targets of roughly 3,000 for gold in the next 24 months and $50 for silver. So this $50 for silver would completely drive all our junior miners exponentially. And I am here very confident that across all the asset classes, this is the best value play that you can afford yourself right now. With all that said, guys, I am nevertheless still in all the value plays that I've been showcasing to you in my previous videos into my Telegram alert group. We've done quite well, I think, with Apple. The cash secured puts that I've been selling, I've been printing absolutely. I am still in Warner Brothers and Discovery, not yet shaking out of that play due to the value factor behind, and I'm planning to stay in for now. Despite all the recession narratives, as I said, no one can time that properly, so I'd like to still partake in the market. The same when it comes to Piedmont Lithium. And as you've seen on the previous charts, of course, PayPal, I still like how we hold those yellow line of $63. I guess there is still a certain accumulation happening, and we are yet to cover the $72 gap at the very, very minimum. When it comes to Bitcoin, I was anticipating this retest into the order block at around 61,500. So we actually scaled in, and I was expecting that's gonna give us a nice bounce at least to further on following Monday low. Right now, we are actually within this Monday low. We are starting to accept above. And for those reasons, I would at least expect the retest of the Monday high at around 65,500. So if you did not follow my alert and didn't enter Bitcoin at 61,500, I can recommend you to do the following. You enter at the Monday low, which is 62,700. Your point of invalidation is the market structure break, I would say 61,500. So you're actually aiming to not starting to close below this low, and your target all the way into the previous range, I would say all the way towards 68,000 as the TP2, and the TP1 will be, as I mentioned, the Monday high of 65,500. So your TP1, your TP2, just explaining how would I play the Monday range, just a simple scalp, nothing sophisticated here, and giving you my reasoning so you can actually onboard it for other plays. Monday range is something quite useful to play due to the fact that multiple traders are actually acting accordingly. So they would start entering their position around Monday low as soon as they're holding it, and they would start offloading around the Monday high. So that starts to act as the point of support and resistance respectively.
Trading can be, of course, very profitable if you're careful with risk management, if you know what you're doing, if your strategy has the good win rate by now. But what I really recommend on top of everything is to use the power of compounding, which Albert Einstein called the eighth miracle of the world. This allows you to not lose on the taxes and commissions in any particular trade, and slowly by slowly growing your stack into the retirement. And here there are multiple studies, just 2% that you normally could pay to your mutual fund already would mean hundreds of thousands of dollars into your retirement. That's why the partner of today's video is actually iTrust Capital, that allows you to transfer your account into existing or new IRA or Roth IRA account, roll over your 401k or other accounts, and take advantage on taxation.
Guys, thank you so much for your time. I wish everyone an amazing end of the week. I also would like to ask you to put in the comment section down below 2 favorite altcoins that you would like me to chart. I'm gonna be with the stream on next Wednesday when we're gonna have more time to go specifically into Bitcoin and other altcoins and see where we see the value at the current levels and where we would like to load on spot and leverage. And on Friday, I'll be back with more stock-related and macro-related update. With all that said, have a great one.